The subcommittee will come to order. Without objection, the chair is authorized to declare a recess of the subcommittee at any time. Without objection, members of the full committee not on this subcommittee are authorized to participate in today's hearing. As a reminder, I ask all members participating remotely to keep themselves muted when they are not being recognized. The staff have been instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members are also reminded that they may only participate in one remote proceeding at a time. If you're participating remotely today, please keep your camera on, and if you choose to attend a different remote proceeding, please turn your camera off. For the benefit of the witnesses, in case you haven't been fully briefed, there will be members who are in the hearing remotely, and consequently they will appear on the various screens, and you will hear, just as you heard the sort of voice of God, those questions coming in via the audio. And so we'll proceed, but not every member will be in the room the whole time. This hearing is entitled Lending in a Crisis, Reviewing the Federal Reserve's Emergency Lending Powers During the Pandemic and Examining Proposals to Address Future Economic Crises. I now recognize myself for 4 minutes to give an opening statement. Last March, as COVID-19 tore through the economy, Congress and the Federal Reserve stepped up to prevent further chaos and to stabilize markets. With businesses shuttering, infection rates rising, and the stock market in a free fall, the Federal Reserve took unprecedented action to keep credit flowing and instill confidence in our financial system. From the onset of the pandemic, Chair Powell made clear that the Federal Reserve would use its emergency lending tools to help families, cities, and businesses weather the storm. Now, more than 18 months removed from their establishment, Congress should take this opportunity to measure their success, identify their shortcomings and limitations, and perhaps most importantly, discuss ideas about how we should address the next economic crisis. I came to this institution in 2009 amidst another economic crisis and a great deal of skepticism around Fed authorities. I never imagined that a mere decade later we would be using those authorities once again to save the economy. So today we will look at 3 lending facilities that were stood up by the Fed and supported by CARES Act funds: the Secondary Market Corporate Credit Facility, the Municipal Liquidity Facility, and the Main Street Lending Program. While these 3 programs do not represent the full scope of the coronavirus toolbox, they offer valuable insight into how the Fed can help when the economy is in shock. At a glance, and compared to other efforts like the widely used Paycheck Protection Program, these facilities look like a blip on the radar with relatively low rates of uptake. It's possible, however, that the Fed's commitment to supporting the economy itself helped calm the markets. Within days of the Fed announcing programs to bolster the corporate municipal bond markets, investors returned, liquidity increased, and further disaster was likely avoided. We learned that the Fed could play a powerful role when it has the authority to make and execute plans. But this power only goes so far. Despite markets calming, the pandemic still forced hundreds of thousands of businesses to close and pushed unemployment rates to unacceptable levels. In times of economic stress, perhaps the 2 most important institutions to stabilizing the economy are Congress with its fiscal power and the Fed. As policymakers, Congress can learn from the accomplishment and setbacks we saw last year to determine how we should confront the next recession. The Fed should also learn from these experiences, seek feedback, and fine-tune its crisis playbook so it too will be ready to tackle future downturns. Together, both Congress and the Fed must think seriously about how to improve on emergency lending efforts, especially when it comes to helping businesses, workers, and communities who are left behind in the best of times. As we saw last year, the time to discuss these ideas is when the economy is on the upswing, not during crisis. The next economic crisis could be triggered by any number of factors at any time. Chair Powell stated before this committee that the Fed would put its emergency tools away when the time was right. Congress's job is to make sure that those tools remain sharp and effective and ready to take on whatever challenge comes next. With that, I'd like to welcome our panel of witnesses and thank them for joining us today, and recognize my friend, the ranking member from Kentucky, for 5 minutes for an opening statement.
Thank you, Mr. Chairman, and I appreciate you holding this very important hearing, and welcome to our witnesses. Thank you all for being with us and offering your insights on the Fed's emergency lending authorities. As the COVID-19 pandemic raged and the nation and the world were gripped with the economic uncertainty resulting from this black swan health crisis, Congress acted swiftly to contain the damage and aid struggling individuals and businesses. The Fed amplified the actions of Congress by providing unprecedented liquidity and broad-based economic support. Through its 13(3) emergency lending powers, the Fed was able to leverage support provided by Congress to serve as a backstop for various markets during times of severe stress and uncertainty. Today, we will take a look back at the Fed's actions during the pandemic. A retrospective review of the emergency lending powers will help us better understand what worked, what didn't, and if and how the 13(3) authorities should be adjusted to improve the Fed's response to future crises. Specifically, we will hear from witnesses about the Fed's Municipal Liquidity Facility, Main Street Lending Facility, and Secondary Market Corporate Credit Facility. At a time when states and municipalities were facing budgetary uncertainty due to lost tax revenue, decreased tourism, and broader economic challenges, the Municipal Liquidity Facility was designed to ensure they could still access markets for financing. The Main Street Lending Facility was designed to aid those businesses that were perfectly healthy before the pandemic, but were too big to utilize the Paycheck Protection Program, yet too small to receive more targeted support. The Secondary Market Corporate Credit Facility was intended to ensure that secondary corporate bond markets continued to function, allowing businesses across the nation to continue operating. We hope to discuss today how we measure the success of these facilities. These three facilities distributed approximately $38 billion, or just 2.3% of the funds available to the Fed for those purposes. Does this metric suggest that the facilities were unsuccessful, or just the opposite, given that the mere presence of the facilities reassured investors and allowed markets to function? Only 2 issuers utilized the Fed's Municipal Liquidity Facility. Does that indicate that the Fed did not accomplish Congress's goals for that facility, or, once again, was the existence of the facility enough to normalize the markets, allowing issuers to finance their operations through standard market channels? It is important to remember that these are emergency lending powers. The Fed is authorized under specific statutory circumstances to deploy these tools. However, as the crisis abates and economic conditions improve, the Fed must put those tools back in the box. Reliance on and utilization of the Fed's emergency lending powers in excess of their intent risks blurring the lines between monetary and fiscal policy. As we discuss these emergency lending facilities today, we must also keep in mind the appropriate role of the Fed. The Fed is independent and conducts monetary policy. Fiscal policy is our responsibility as legislators. The Fed is not an agent of social change or environmental activism, and asking it to take on that role compromises its independence. This subcommittee has an important mandate of oversight of monetary policy, and as we exercise that oversight over Fed policy, I hope at some point, Mr. Chairman, and in the near future, we will have a hearing specifically on inflation. The inflation data is staggering and concerning as perpetual accommodative monetary policy and blowout fiscal spending make us all question whether it is truly transitory. As the Wall Street Journal reported today, the Fed is looking at this as not so transitory, and I'll quote, "The message from the Fed's latest projections yesterday is that, quote, transitory is lasting an awfully long time. Our constituents are feeling the pain of inflation at the grocery store and at the gas pump, and Congress must do its part to make sure we do not let it get out of control." The economic response to COVID-19 pandemic required collaboration between Congress, the administration, the Fed, and the private sector. As we emerge from the pandemic and economic conditions normalize, it is a useful exercise to look back at the impact our policies had. Today's review of the Fed's emergency lending facilities should provide meaningful and helpful insight. And for that, Mr. Chairman, I thank you for your leadership in holding this hearing. I look forward to hearing from our witnesses today. And again, Mr. Chairman, thank you for convening this hearing. I yield back.
I thank the ranking member, and it's now my privilege to recognize the chairwoman of the full committee, the gentlewoman from California, Ms. Waters, for 1 minute.
Thank you very much, Mr. Chairman, for holding this important hearing. Testifying before our committee in February 2020, Chair Powell warned that the Federal Reserve's ability to help the economy in the next recession would be limited. Remarkably, the pandemic was declared 1 month later, and the Fed exercised an unprecedented expansion of its tools to support the economy. I believe the Fed's actions were helpful in jumpstarting the recovery on Wall Street after a devastating shutdown due to the pandemic. And we had to work very hard with the Fed to talk about extending its support to states, cities, and small businesses. We engaged the chair on the terms that were offered to both the small businesses and corporations. And so I spent a considerable amount of time dealing with all of these facilities that were being created, and particularly the Main Street facility, where we engaged, again, Chairman Powell, on how he could be more helpful to very small businesses. So I look forward to hearing from this panel what worked, what didn't, and what reforms are needed to make sure the Fed's actions reach Main Street and not just Wall Street. I yield back the balance of my time.
I thank the chairwoman for her attendance and her statement. Today, we welcome the testimony of our distinguished witnesses. First, we have my friend, the Honorable Sean Wooden, the Treasurer of State of Connecticut and the President-elect of the National Association of State Treasurers, and the provider of the evidence to my belief that only good things come from the state of Connecticut. Next, we have Mr. Mike Conzel, Director of Macroeconomic Analysis and Progressive Thought with the Roosevelt Institute. We then have Ms. June Rhee, Director of Master of Management Studies in Systemic Risk with the Yale School of Management. Then we have Mr. Christopher Russo, a postgraduate research fellow with the Mercatus Center. And finally, we have Dr. Claudia Sam, a senior fellow with the Jain Family Institute. Witnesses are reminded that their oral testimony will be limited to 5 minutes. You should be able to see a timer on the desk in front of you that will indicate how much time you have left. And by the way, please, when you are speaking, pull the mic close to your, you can remove your mask and pull the mic close to you, otherwise we won't get it. I would ask that you be mindful of the timer and quickly wrap up your testimony once your 5 minutes have expired, so that we can be respectful of both the witnesses and the committee members' time. Without objection, your written statement will be made a part of the record. Mr. Wooden, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you, Chairman Himes, Ranking Member Barr, and distinguished members of this committee. I appreciate the opportunity to testify before you today. Specifically, I'd like to share with you Connecticut's experience with the Municipal Liquidity Facility, which I will refer to as the MLF in my testimony. As President-elect of the National Association of State Treasurers, the bipartisan association of state treasurers from across the country, I've worked with my colleagues on this topic since the early days of the pandemic. As treasurer of the state of Connecticut, I have 3 responsibilities relevant to today's hearing: investment of the state's pension and trust funds, management of the state's borrowing, and management of the state's cash, including maintenance of our liquidity. For today's hearing, I'm going to focus specifically on liquidity issues. Our experience in Connecticut, fortunately, was that the state and its municipalities were able to meet the pandemic's unprecedented impact on state and local governments' budgets and other fiscal challenges. This was due to prompt and effective federal action and assistance, as well as the state's ability to adeptly draw on talent and quickly prepare. At the its fiscal year 2020 budget projections to a much larger $934 million budget deficit. During this time, in early spring 2020, I participated in weekly calls with treasurers from across the country to discuss in real time the challenges different states were facing. At that point, all states were revising their budget projections and liquidity positions. Several states moved ahead and put lines of credit and other short-term borrowing facilities to address what was at the time an unknown fiscal impact from the quickly spreading COVID-19. However, several significant and timely actions taken by the federal government provided substantial assistance to state and local governments and mitigated liquidity concerns. One was the Federal Reserve's establishment of the MLF. A quick look at events in the municipal market at the time shows that shortly after the declaration of the pandemic, the municipal market experienced tremendous volatility. The municipal bond yields rose to dramatically as mutual fund investors pulled over $41 billion of assets out of the municipal market in less than 3 weeks. At that point, market fluctuation had deteriorated to the point that buyers and sellers had difficulty determining price because investors were concerned about our government's ability to withstand the pandemic's related liquidity and revenue shocks. The primary market was essentially shuttered for 2 weeks in mid-March, and municipal bond yields remained elevated even as markets slowly reopened. The Federal Reserve's initial actions helped shore up market liquidity. The creation of the MLF provided critical support for issuer solvency by standing ready to purchase short-term notes from state and local governments in an extremely uncertain economic environment, thereby helping state and local governments better manage cash flow pressures. The MLF was designed and implemented to serve as a lender of last resort. Despite the limited utilization of the program, it provided a necessary backstop to a large market without replacing the normal municipal market mechanisms for raising capital to alleviate liquidity concerns. Today, I present 7 changes for your consideration for the purpose of improving the MLF to be shelf-ready for the next fiscal crisis. And this reflects Connecticut's experience as well as the experience of treasurers across the country on a bipartisan basis that was shared with Treasury at the time. Number 1, I recommend reducing the MLF's borrowing rates to a more competitive taxable market rates that move with the market. Number 2, I recommend removing the requirement for certification that borrowers are unable to secure adequate credit accommodations from other banking institutions. The above-market pricing model makes that certification redundant. Number 3, I recommend making the requirement that state guarantee borrowings of municipalities that borrow through the state, that be more flexible, and consider having the Federal Reserve assume some of the credit risk. Number 4, the MLF should be available for pooled borrowings, not one-off guaranteed borrowings for particular municipalities. Number 5, allow for longer credit terms, and we recommend that will improve the relief available to issuers by extending the MLF credit facility for longer-term issuers. Number 6, make the program permanent. It would be valuable and forward-thinking for the Federal Reserve to put in place a permanent emergency MLF program and set parameters that consider the variety of states' needs and circumstances. In Connecticut, we found that legislative changes to our statutes would be necessary in order to implement the prior program. And lastly, if I may, Mr. Chairman, create a bank-managed program, and that would be much more efficient to execute. Thank you for this opportunity.
Thank you, Mr. Wooden, and I'll be equivalently elastic on the time for the other witnesses. With that, Mr. Consul, you're now recognized for 5 minutes to give an oral presentation of your testimony.
Good morning, and thank you for inviting me to testify at this hearing. My name is Mike Consul. I'm the Director of Macroeconomic Analysis at the Roosevelt Institute.
Sir, can you pull the mic a little closer?
Absolutely. I would like to discuss the emergency lending facilities that the Federal Reserve used to respond to the COVID-19 crisis. I'd like to make 3 points. First, the Municipal Liquidity Facility, the MLF, and the Secondary Market Corporate Credit Facility, the SMCCF, were more successful than people realize. We see dramatic effects if we look not just at the total number of loans made, but instead at their overall impact on interest rates. Second, these programs are an evolution of unconventional monetary policy in our era of low interest rates and are likely to stay with us. And third, there are multiple ways to improve these facilities going forward. Take the MLF and municipal debt markets as the first example. During March 2020, yields on municipal debts dramatically increased. The MLF was poorly designed to address this crisis. Its original narrow terms meant it was very difficult for any subnational entity to qualify, especially cities with the highest concentration of Black and brown residents. Even as the Fed expanded at the eligibility threshold throughout that summer, only 2 borrowers took advantage of the program, borrowing only $6 billion out of the $500 billion available for lending through this program. Yet the interest rates municipalities face dropped dramatically throughout this period. A wave of research over the past year has found that this decrease is driven by the announcement of the MLF and its subsequent expansions. Research from the Federal Reserve Bank of New York found that municipalities eligible for the expanded terms at the end of April saw their interest rates decline around 70 basis points. Research from the Federal Reserve Bank of Dallas found that the MLF kept rates from rising between an estimated 5 and 8% as the economy deteriorated. Researchers at the Federal Reserve Bank of Chicago found an impact of 110 basis points for a sample of US states. This research argues that the MLF disproportionately benefited municipalities with higher credit risk. There are many studies summarized in my written testimony, and though they all use different methodology, they all point in the same direction. The same story plays out in the corporate sector. Interest rates on corporate bonds spiked during March 2020. Though the purchases of the SMCCF were only $13 billion, a trivial amount in the world of corporate debt, the impact was dramatic. Researchers across studies find a dramatic drop in the interest rate corporations faced, with the general conclusion that most of the impact occurred before the Fed even bought anything. These two programs mirror each other. Even though the Federal Reserve purchased virtually nothing and incurred no fiscal costs, the chance that it could was enough to drive down borrowing costs and calm markets for these sectors. It is through this lens, seeing asset purchase as an extension of unconventional monetary policy that sets long-term interest rates for users of funds in the economy, that the impact and promise of these programs make the most sense. We will likely still need such programs in the future. Unconventional monetary policy is necessary during periods of low interest rates, and over the past several decades, interest rates have fallen across countries. Right now, the 10-year Treasury rate is around 1.3%, which is below the 6 decades preceding the pandemic. Economists are engaged in debates over why interest rates have fallen, with popular theories including increasing wealth inequality, the aging of the population, and more concentration in sectors across our economy. These trends are likely to stay with us. And indeed, this expansion of unconventional monetary policy is also happening at other central banks across the world. Multiple other central banks created or expanded already existing corporate bond purchase facilities in 2020, including in response to the COVID crisis, including the central banks of England, Europe, Japan, and Canada. Luckily, there are multiple ways to improve these facilities. The Federal Reserve should research how expansive it can make eligibility requirements for any future municipal lending facility. This has significant benefits with low costs. The eligibility does matter quite a bit in who gets to benefit from this. The Federal Reserve should remove or reduce its penalty rate for any future programs like these. The penalty rate makes perfect sense for times in which we want to guard against moral hazard, especially in a financial crisis. But when programs are being used as part of a general toolkit of unconventional monetary policy and rate setting, the penalty rate makes less sense. And third, beyond program design, there are general policy changes that should be considered. Better regulation of open-ended mutual funds can help prevent debt markets from seizing in crises on such short notice. Also, these facilities are no substitute for fiscal policy. Better automatic stabilizers would help maintain incomes and spendings in a recession and take some of the pressure off unconventional policy. Thank you for your time, and I look forward to any questions you may have.
Thank you, Mr. Consul. Ms. Rhee, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you, Chairman Himes, Ranking Member Barr, and the members of the subcommittee. Thank you for inviting me to testify at this hearing. My name is June Rhee. For the past 6 years, I have been researching at the Yale Program on Financial Stability on interventions used by the government and central banks in response to financial crises around the world. The focus of my research has been on market liquidity and capital injection programs. In these remarks, I will focus on my research in market liquidity programs by the Fed during the global financial crisis and the COVID-19 pandemic, based on papers I have co-authored. We define market liquidity programs as interventions for which the key motivation is to stabilize liquidity in a specific wholesale funding market, which encompasses the 3 facilities we're focusing on today in our hearing. The Fed is allowed to extend loans to non-banks in normal times, and its power to purchase market instrument is limited. Therefore, the Fed relied on its authority under Section 13(3) of the Federal Reserve Act to lend to non-banks in unusual exigent circumstances. The Fed also created special purpose vehicles, or SPVs, to purchase specific instruments and lend money to them using its emergency authority. The SPVs in turn purchased assets to help restore liquidity in troubled markets. Lending under 13(3) also requires the Fed to be secured to its satisfaction. The Fed has taken a variety of paths to make sure it is secured to its satisfaction. In one facility during the GFC, it required borrowers to pay fees, which in aggregate functioned as a loss reserve. In another facility, It required money market funds or other investors that elected to sell assets to the SPV to then purchase subordinated debt issued by the SPV equivalent to 10% of the value of the assets they sold. It is also relevant to note that of all the Fed's lending facilities established under 13.3 during the GFC, only one facility received credit protection from the Treasury, which is quite different from this time around. In part because the Fed's indirect asset purchase programs during the global financial crisis were more complex than the direct asset purchase programs set forth by other central banks around the world, the implementation took a little bit, for some of the programs, the implementation took a little bit more time. The ability to roll out a program quickly can provide benefits in some cases, serving as a bridge as other programs are put together. Fed economists involved in constructing some of these programs have also stated that, in hindsight, earlier rollout of some of these programs might have made them more effective. Ultimately, however, whether an intervention was indirect or direct does not seem to have had much influence on its effectiveness. Following the GFC, the Dodd-Frank Act added some restrictions to Section 13.3. Under the revised law, the Fed retains the ability to conduct market-wide liquidity programs, but it now must obtain Treasury Secretary's approval before establishing such a program. Also, it is required to report to Congress detailed transaction-level information on any loan extended under a Section 13.3 program within 7 days. Disruptions caused by the COVID-19 pandemic again drove the Fed to open market liquidity programs, some like GFC-era ones and some new ones, using Section 13.3 authority. Armed with the know-how from the GFC, the Fed was able to quickly reintroduce 4 GFC-era market liquidity programs. It also introduced new programs, and the 3 programs that we are talking about today are the new programs that the Fed introduced. For the reopened programs, the Fed, much of the design was the same as their GFC-era counterparts. However, unlike the GFC-era facilities, again, the COVID-19 era facilities, aside from 2 facilities, received Treasury's credit protection. The relevance of this is that the Consolidated Appropriation Act 2021, signed into law on December 27, 2020, definitively closed these CARES Act Fed facilities and rescinded funds not needed to meet the commitments as of January 9, 2029 of the programs and facilities established. The Act preserves the Fed's authority under Section 13.3. However, the Act removed Treasury's authority to use funds to support a Fed facility that is the same as the 3 facilities that we're talking about today here. The Act made an exception for TALF, which is a facility that was also open during the GFC era. How broadly the Treasury will interpret the same as language in the future remains an open question. Therefore, if the Fed wanted to create a lending facility that falls within the scope of the Act in the future, it may have to find other ways to secure the loans to its satisfaction, such as using risk management techniques used during the GFC era facilities. But there also may be some need for the Treasury to support a future lending facility. If you are comparing GFC facility versus the COVID-19 facility, the COVID-19 facility with the Treasury support was able to accept a much broader range of eligible collateral than a similar facility that was open during the GFC era. Of course, all Fed lending facilities under the Section 13.3 will continue to require the Treasury Secretary's approval. This concludes my remarks, and thank you. I will welcome all questions.
Thank you, Ms. Rhee. Dr. Sam, you're now recognized for 5 minutes.
Thank you. So I greatly appreciate the opportunity to give remarks on the municipal liquidity facility. I'm going to focus on 3 ways that this emergency facility for state and local governments could be improved for the next crisis. First, we should tailor the eligibility and the loan terms so that they are specifically for state and local governments experiencing financial distress. To do so, use economic conditions, particularly conditions in the local labor markets, to make those determinations. And finally, improve the administrative systems so that it is as easy as possible for those who need the relief to access it. We know that swift and effective relief is absolutely essential in times of crisis. I began at the Federal Reserve in 2007. In my first year, I watched the global financial crisis and the Great Recession have an incredible toll on families, small businesses, communities, and that lasted for years. This time, you all stepped in very aggressively, boldly, and what Congress did and what the Federal Reserve did early in the crisis in particular was a godsend. But when you're innovative and bold, you can always do better. And so it is the perfect time to reflect, hold those accountable who were in charge of implementing these policies, and to prepare for the next crisis. Before I go through the proposals in more detail, I just want to focus us on the stated purpose of the Municipal Liquidity Facility, as it is on the Federal Reserve's website, to help state and local governments better manage the cash flow pressures they are facing as a result of the increase in state and local government expenditures related to the COVID-19 pandemic and the delay and decrease of certain tax and other revenues. So we've talked about the success metrics. The municipal bond market did stabilize. It stabilized quickly, took a little longer for those that were didn't have as good a credit ratings, but we got there. That's a success and it should be recognized. That said, 2 loans were made to state and local governments, and we know that there were more than 2 that were suffering during this crisis and continue to. So let's do better. In the key features that we've talked about, the size, and only about 1.5% of the loans were accessed. The eligibility was largely by population. We now know that a lot of the budget stresses were not concentrated in some of our large states and cities. So we need to get the money to who needs it. And as was mentioned before, the state and local governments only had access to bonds up to 3 years of maturity. They were more than that for corporations. So with the first proposal to target eligibility, as I said, we know that population was not enough. The Fed had to reverse course and lower the population thresholds in August. That was too long to wait for that. And we also, if we do better targeting, then it'll be the state and local governments that most need the aid, and we can potentially reduce penalty rates. We can subsidize those rates because you aren't opening up to all institutions, right? You can be very targeted and tailored in the relief. Now it's a big question, how do you do that? Targeting, I suggest using local economic conditions. The Bureau of Labor Statistics puts out very detailed subnational statistics. No one can influence them, and they do tell us about the hardships that workers are facing and businesses in a crisis. And finally, administering these programs is essential. The signing ceremonies are not enough. The Fed announcements are not enough. The cash has to get to those who are eligible and those who need the relief. Innovation is hard, right? The Fed stood up a facility that did not exist before this crisis. It was delayed relative to the facilities that were directed at Wall Street. The terms had to be adjusted. There was a lot of debate among Fed and Treasury about exactly who should be eligible. That created uncertainty for state and local governments. We can't do a one-size-fits-all. State and local governments, nearly all of them have balanced budget requirements. They really have faced a lot of uncertainty in terms of revenues. We need to make it easier for them. I just think the Federal Reserve is a way that Congress can get money out. Congress needs to lead, but the Fed can be a very effective way to implement the policies and the relief that you want to see done. Thank you.
Thank you, Dr. Sam. Mr. Russo, you are now recognized for 5 minutes.
Good morning, Chairman Himes, Ranking Member Barr, and members of the subcommittee. Thank you for inviting me to speak today about the Fed's emergency lending facilities. My name is Christopher Russo. Before joining the Mercatus Center at George Mason University, I advised senior Fed officials on a range of monetary policy decisions. Today, I urge you to safeguard the Federal Reserve's independence by keeping the Fed out of credit policy. Really, my arguments can be boiled down to just 3 points. 1, the Fed's role as lender of last resort is essential to achieving its monetary policy objectives, these same objectives that you have given it. 2nd, 10 of the Fed's emergency lending facilities cross red lines from monetary policy into credit policy. And 3rd, crucially, using the Fed for credit policy damages its independence, making it less effective in the next crisis. I think we will agree on my first point, that the Fed as a lender of last resort is essential to achieving the goals you've given it: maximum employment and price stability. Congress created the Fed for exactly this reason, following a dash for cash on Wall Street in 1907 that led to a banking panic and then a contraction on Main Street, massive one. To be clear, that's 1907, not 2007. And we've known what to do since 1802. The Fed, as the lender of last resort, lends to banks without limit in a timely manner based on good collateral and at a penalty rate. Those 5 elements of the lender of last resort doctrine are essential. They've been developed since hundreds of years of financial crises, since we started having them. The purpose of the lender of last resort is liquidity, not credit. And all 5 points matter for that purpose. The Fed's first test came in 1929. Faced with yet another banking panic, the Fed dramatically failed. It did not lend to banks without limit or in a timely manner. And in doing so, healthy banks were forced to fail. These mistakes compounded what would have been a bad but, once in a few years recession into the Great Depression. The Fed has learned the lesson from the Great Depression, in my view. As former Fed Chairman Bernanke vowed, never again. I also think we will agree on my second point, that recent emergency lending programs crossed red lines from monetary policy into credit policy. Fed Chairman Powell said so himself. 10 of the emergency lending facilities were designed to assist Congress and the Treasury in allocating credit, not liquidity, to the broad financial system. These credit programs don't meet the 5 requirements I outlined for a lender of last resort. They lend to non-banks at favorable rates and with shady collateral, with respect. For example, the Fed's municipal loan facility made direct loans, and as we've recognized here, only to the state of Illinois and the New York MTA. The Fed can't create new savings from nothing. It can only shift them around. And like any government subsidy, it benefits some, as has been described, but the unseen harm comes to others, and that's less recognizable in some of the studies that have been done. I would also mention that when we talk about the effect of the Fed on markets and these and other actions, market volatility, price volatility, that itself is not dysfunction. That itself is not illiquidity. So for all of those reasons, I hope we will agree on my third point, that involving the Fed in credit policy damages its independence and its effectiveness. Congress recognized this in the 2010 Dodd-Frank Act after the global financial crisis. Congress specified that emergency lending is for unusual and exigent circumstances. It must be broad-based and only for the purpose of providing liquidity to the financial system. Congress put these restrictions in place because in the global financial crisis, the Fed had lent to non-banks on Wall Street, and it lent credit. It wasn't involved in liquidity because these firms were deemed too big to fail. Congressmen, Congresswomen, it is the same principle. Whether it's non-bank borrowers on Wall Street, K Street, or yes, even Main Street, credit policy is political, and it is not the Fed's proper role. So I ask you to resist this siren's call of turning the Fed from our central bank into our piggy bank. Whether the Fed finances green energy or the construction of a border wall or anything else, it would subject the Fed to immense political pressure. The damage to the Fed's independence would harm its effectiveness in the next crisis. And as we saw in the Depression, that does not end well. Congress regularly asks the Fed to take on more power. So far as I know, the Fed is the only government agency to refuse. Instead, I ask, like Fed officials have many times, that you safeguard their independence so they can do the important jobs you have given them. Thank you again. I look forward to answering all of your questions.
Thank you, Mr. Russo. I now recognize myself for 5 minutes of questions. Mr. Wooden, let me start with you. You're the one sitting straight state treasurer on the dais right now. There have been proposals made to make more permanent, to make more predictable, to make more stable these programs. One of the things Congress does worry about and should worry about is moral hazard. The idea that if that backstop is out there, it may cause folks in your position to know that it's there and therefore perhaps be less prudent in the decision making. How would a state treasurer think about that? And how can Congress be made more comfortable that if these programs were more predictable and just simply there, that we wouldn't see less prudent behavior on the part of decision makers at the state municipal level?
Thank you for that question. And first, let me say, I think just based on the numbers alone and what actually happened with the program, it was an unmitigated success in terms of stabilizing the markets, right? Part of the discussion, and as a treasurer, I am Main Street, right? I see day to day on the front line what's happening with governments and essential services and concern about meeting payroll. The moral hazard argument, this program was structured and implemented as a lender of last resort in terms of that standard was met. Now, I think there is reasonable disagreement and debate on whether or not there should have been the penalty associated with it and off-market rates, but it did the job in terms of being a lender of last resort. And so I think there was in fact zero harm of moral hazard in this event, and that proved out by the fact that there were only 2 issuers that utilized it. But there were many issuers, like the state of Connecticut and others, who benefited and who helped stabilize our access to the marketplace in a way that did not harm government, but help government and help Main Street in Connecticut.
Thank you, Mr. Wooden. I have one more question that I just want to throw out there, sort of a jump ball. I've watched or participated now, sadly, in any number of interventions in the market. I wasn't in Congress, but the Mexico bailout, then, of course, the infamous Wall Street bailout, the auto industry, and now everything that we've done. That's not the way markets are supposed to work, but those of us in Congress are put in the position of choosing between doing something which buttresses the markets not the way they're supposed to work, or watching the apocalypse unfold. One of the things, if we're going to continue to do these programs, I would point out that I think that all of the programs I just mentioned actually didn't cause any loss to taxpayers, and in fact, in many cases, provided a gain to taxpayers. But one of the challenges is that these programs are perceived by my constituents, and I think by Americans, as always benefiting the corporation or management. Why? Because the proceeds are often used to pay bondholders. And so workers and others are left to say, wait a minute, once again, you're bailing out the corporation I work for, and what do I get? And in many instances, those workers are laid off. Now, you don't need to be too far to the left of the political spectrum to say that that's a problem. So my question is, and I posed this question to Chair Powell some time ago, how can these programs be thought of and restructured in ways that at least alters the perception that they are all about corporations and businesses servicing their debts rather than standing by their workers? Dr. Sam, you're the first one with the mask off. So
I buzzed in. So I think there was a big step forward in this crisis. You have 2 new facilities that lend directly to Main Street. So putting those on equal footing in terms of terms, eligibility, how fast they get started, that's a big step forward. And so I really applaud that attempt to get money directly to Main Street. And I think that's what people want to see. We don't want Wall Street to go down, but we don't want Main Street to either.
So you're saying, and I agree with you, that if we make these credit facilities available to smaller businesses, that mitigates some of the sense of we're just bailing out the banks. But what else? The Federal Reserve hasn't, and maybe the answer is there's nothing you can do. You just, as an elected official, need to explain to people that when you stabilize Delta Airlines, you're doing a good thing for the economy, even if Delta Airlines turns around and lays off employees. But is there anything we can do to try to address that perceptual issue?
Fiscal policy, right? I don't think in a crisis people care where the money is coming from, whether it's the Fed helping keep interest rates low or it's Congress getting stimulus checks in their pocket. So I think it's more about the concerted, all hands on deck approach.
Thank you, Dr. Chum. I'm out of time, but appreciate that response. With that, I now recognize the distinguished ranking member for 5 minutes of questions.
Thank you, Mr. Chairman. Let's talk about the how we measure the success of these emergency liquidity programs. We heard, members of Congress heard from market participants that TALF in particular and the corporate credit facilities were a psychological backstop, and even if the utilization wasn't there, that there was that the markets weren't seized, that they actually functioned because there was this psychological backstop that was there. And so I mentioned in my opening statement, it's important that we grasp how to measure the success of these facilities. Looking simply at utilization or take-up makes them perhaps look unsuccessful, but a broader look at the market and credit conditions in this unprecedented economic shutdown and evaluating it through the lens of the Fed serving just as a backstop, but not as necessarily a provider of credit, might indicate that they were successful. So, Mr. Russo, how would you evaluate the performance of the Fed's facilities, and what metrics should we actually use to judge their success?
Congressman, thank you for that great question. As an economist, I think it's important to look at the benefits of a policy as well as the drawbacks. So one thing that hasn't been mentioned already in terms of the drawbacks of such a policy is, first, there's only so much real economic savings to be allocated. Again, that's all the Fed can do. They can allocate savings. So when the Congress or the Fed or anybody else decides to allocate more savings to New York and Illinois, they're taking it away from somewhere else. You don't see where, but that's a real drawback. Second thing I'll mention is that by trying to peg prices, in this case an interest rate for credit, you do make some better off and some worse off, like any subsidy. So, for example, Illinois got better rates if we buy the arguments that were put forth before on its municipal loans. That gave a worse return to the pensions that own those bonds or that finance that new investment. So again, I think there's a complicated cost benefit we could do here, but I would just remind you of those other sides of the ledger. And again, this is not really the Fed's role to be doing credit policy.
Yeah, let me stick with you and that point that you're making. Some of our colleagues have suggested that the Fed should take a more active role in addressing social or environmental issues. Some have even gone as far to suggest that the long run changes in weather patterns due to climate change are emergencies and thus necessitate the Fed using its 13.3 emergency lending powers to directly finance green energy. Mr. Russo, what would the impact be on the Fed's independence if it strays outside of its mandate and actually took a more active role in social and environmental issues?
I believe that its independence would be irreparably damaged, and in doing so, it would weaken its independence and its effectiveness in the next crisis.
Mr. Russo, I want to ask you now about the penalty rate. Some have contended that the terms and rates, and some of your fellow panelists here have contended that the terms and rates of some of the Fed's facilities are too onerous, resulting in lower uptake if prices were more aligned with market rates. As you know, the Fed is required by regulation to charge a penalty rate at a premium to market rates in normal circumstances. This is in part to ensure that the Fed maintains its role as a backstop and provider of liquidity rather than replacing private markets. What impact would an adjustment to the requirement of the Fed to charge a penalty rate have on its role in the economy? And could that change its role from a backstop to a direct competitor with private entities?
Not could, would, sir. Thank you again for that question. To give you some context here, the Fed's loan to Illinois, that was a direct loan, had an interest rate of about 3%. We've seen the inflation in the last year in real terms, not dollar terms, but in real terms, inflation adjusted, that's a negative return. So just to summarize, when we reduce any of those 5 criteria I set out for a lender of last resort, you no longer have a lender of last resort, and that includes getting rid of penalty rates.
Yeah, I think preserving the role as lender of last resort is very important and not displacing the private sector. Final question to Mr. Russo. In the 115th Congress, when I chaired this subcommittee, I sponsored a package of Federal Reserve reform bills which included a bill called the Congressional Accountability for Emergency Lending Programs Act. Mr. Hill was part of this effort. The bill would require the affirmative vote of a greater portion of the FOMC than is currently required. It would also require an additional and enhanced role from Congress to authorize these emergency lending authorities. Of course, the CARES Act did interject the Congress in approving some of the emergency lending that we saw in the pandemic. But what are your thoughts on a bill like this to strengthen the congressional role, to limit the Fed's emergency lending powers, not eliminate 13.3, but just provide a little better accountability, involve more of the members of the FOMC in this?
Thank you, sir. I believe that Congress plays an important role in the oversight of the Federal Reserve. I can't comment on that legislation specifically, and I don't endorse legislation, but I'd be happy to work with your office on these issues going forward if that'd be helpful.
Thank you, Mr. Chairman, for your indulgence. I yield back.
Thank you to the ranking member. The chairwoman of the Financial Services Committee, Ms. Waters, is recognized for 5 minutes.
Thank you very much, Mr. Himes. I'd like to continue the discussion that you have initiated around maximizing the public interest. Mr. Conzal, we know that emergency financial system assistance is sometimes necessary to rescue our economy when it is in crisis, but carrying out this assistance in a way that protects workers and has other reasonable conditions attached is critical. For example, in 2009, the Treasury Department extended $62 billion in assistance to General Motors and Chrysler, which helped to save 1.5 million jobs. However, Treasury was eager to exit its investment as quickly as possible. It sold its stake in both companies without securing any improvements in workers' wages or other corporate practices. And its sale came at a loss, even though GM and Chrysler were profitable just a few years later. Last year, we set aside $17 billion in the CARES Act to help national security firms like Boeing, but put conditions on that assistance such as workforce maintenance requirements. Boeing did not end up using that aid, instead opting to sell a corporate bond after the Fed's actions unfroze the corporate bond market. Because the corporate bond market didn't have the same strings attached as the CARES Act national security funds, Boeing proceeded to lay off 12,000 workers. Mr. Conzal, what ideas should Congress consider to ensure future emergency lending programs are carried out in a way that is in the public interest and maximizes the vital goals of full employment and economic stability?
Thank you for that question. So a few thoughts on that. One is that in so much as that a lot of these facilities are setting market-wide interest rates and bringing them down when traditional monetary policy is weaker at doing that, it is very hard to put on conditions at that point. So you want to think about fiscal policy. You want to think about managed settlements, particularly in times of crisis like we did with the airlines. I contrast these programs with the payroll protection program. As compared to these programs, the payroll protection program had significant take-up, approximately $500 billion with 5 million loans. And there you had a downside from the point of view of business, but an upside from the point of view of the public of having significant terms on those loans, particularly payroll. In exchange for that, there was the upside to the business of having those loans turned into grants. With these emergency lending programs, it's very difficult to have that kind of balance because we're working through interest rates. So you can try to put penalties on. The primary market corporate credit facility, which would have made direct loans to corporations, had no uptake because it had a penalty rate. The Main Street lending facility, for instance, had some obligations that mirrored the payroll protection program, but also saw limited uptake. So one needs to think about the balance of upside and downside for the business in terms of making sure that we can carry out programs, so we can carry out public obligations in exchange for support. I also think that automatic stabilizers are quite important. I think unemployment insurance, the expansion in the CARES Act and the American Rescue Plan was very important in helping ensure that workers got through this and got an equitable shake of the downturn that we went through. And finally, direct support to cities and municipalities in the American Rescue Plan was incredibly important.
Well, thank you very much. Let me just say that despite the fact that in emergency assistance to these companies certainly are concerned with the economy and what is happening and how can we protect having a safe and sound economy, et cetera. But I certainly would not like to think that we can excuse these corporations from using our leverage to ensure that they protect workers in some way. And don't you agree that both can be done?
Yes, absolutely. And I think there are some models we can look back at what happened with the airlines, I think is one possible role and model going forward. Legislation has been introduced about a bailout manager that I think is really worth discussing and thinking through. And reassessing, you look at the Main Street lending facility, which put a ban on buybacks and dividends for firms that took them. And that was enforced. And, the sky didn't fall when we banned buybacks and dividends or slowed the rates at the largest banks. And so there are obligations that can be put in place that we saw a limited version of that worked perfectly fine and still left corporations in a perfectly good place to be able to expand in this recovery.
Thank you very much. I yield back.
Thank you. The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Chairman, thank you very much. I want to thank the panel that's here before us today and want to engage several of the members of the panel. Ms. Marie, I want to say to you, I listened very carefully to what you talked about liquidity. And liquidity in the marketplace is always an indication to me about what's available and what exists and those sorts of measures. And I, with great interest, listened and appreciate your comments. Dr. Salm, in looking at your written testimony on page, well, the pages aren't here, so it may be 5 pages back. You talk about changes in state revenues during COVID. And I note, among others, Delaware, huge increase of revenue to the state. And I don't know whether this was above what was projected or what it could be. Did this include federal money that would flow in or just revenue generated by the state?
No, these were just revenues by the state, but they include, say, corporate profit income taxes. So that's an important piece of Delaware. The point of that chart is mainly to show that there are wide variations in the tax revenue shortfalls. And to your point, or to your question, largely the shortfalls were less than expected in March of 2020.
Yes, and in looking at those, I looked at California as being a significant increase. Is that an indication about business as usual and increases in a quote COVID era, or what would you look at that and draw a conclusion about?
Well, year to year, we do expect increases in tax revenue. So the particular numbers, say for the state of California, I wouldn't generalize so broadly in terms of how much relief they got in this crisis. And also, this is only the tax side. Expenditures rose in a lot of places. Again, I think that that's a really good argument as to why the municipal liquidity facility could have been better targeted. And you might argue that the direct aid that was in the American Rescue Plan could be also to where there are really economic distress.
Yes, and I think that's a point, going back to Ms. Ree, you need to look at the liquidity to see how sick the patient is or how well the patient might be to draw that conclusion. Mr. Russo, in looking at your testimony, which I really appreciate, today the Wall Street Journal has an article that I engaged the president of the Dallas Fed on. Really, he engaged me on it, and that is the Fed prepares to pull back on stimulus. The president of the Dallas Fed talked to me about how he believed, and I think the word is temper, or put a brake on, reduce. The Wall Street Journal today talks about really what I think should be part of this hearing, so I'm going to make it part of the hearing. The projections Wednesday show half of the officials expect interest rates would need to rise. The main catalyst, going to another paragraph, the main catalyst of the problem is the fact that inflation has accelerated faster than anticipated and is remaining elevated. At some point, there's danger to what we're doing, isn't there? Can you lend too much money or accelerate the marketplace beyond normal? What would you say about that?
Sir, I think, and thank you for the question. I think what you've articulated there is correct. The Fed often looks at what they say are balance of risks. So in the last decade, the balance of risk has really been to the downside for recession and for low inflation or even deflation. And entering the coronavirus pandemic, my perception is that they were trying to address that immediate issue with as much monetary stimulus as they could. And I approve of those actions. Things like lowering interest rates to zero, doing large-scale asset purchases, acting as an actual lender of last resort. Those, I think, are on point. And so long as the Fed remains independent, they can modify those actions as appropriate to keep inflation on track. And that's, again, I think the important thing, their independence to be able to do that.
Thank you. One question to the panel. Anybody can answer this. During the last 2 years, there has been an extensive amount of national debt that was taken on in the trillions. What would we anticipate the interest rates to be next year just off that new loan amount? Has anybody looked at that, the interest payments that we will need to make in 2023 just based upon the extension of monetary to money in the last 2 years?
Sir, based on where we are right now, in general, interest rates are projected to remain low, at least into the next year. Going further out, you might have more uncertainty. There's a question, though, as you've raised, and I think you're alluding to, that the unsustainable rise in debt could lead to a situation either through a debt crisis or not even a crisis in which you have sustained higher interest rates. That is an economic possibility we've seen many times in history before.
Yes, Mr. Chairman, if I could just have one more minute, sir. I'm talking about that we will have to pay of interest.
Yes.
New interest payments based upon what has occurred the last 2 years. What is that incremental amount? Has anybody figured that out at near zero interest rates, but we still have to pay interest on this? Does anybody know what that might be?
Sir, I don't have that number, but I'd be happy to talk to you afterwards and get that number for you.
Right, thank you very much. Mr. Chairman, thank you very much.
Thank you. The gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you, Mr. Chair. Mr. Russo, I know you had a brief exchange with the ranking member regarding climate change. My first question, do you think climate change is an emergency?
Sir, thank you for the question. With respect, I'm not an expert on climate change. I'm here to talk about monetary policy where I have expertise, not my personal views.
Right, but whether climate change is an emergency will determine whether it poses a risk to the financial stability of the country. I have a question for Mr. Kozel. The Select Committee on Coronavirus found that the credit facilities of the Fed lend disproportionately to oil and gas companies. Do you think that the Fed is planting the seeds of long-term financial instability in lending so heavily to fossil fuel companies?
The studies about the SMCCF basically find that it helped industries across the board. And that specific study found that it underlent to finance and overlent to many other industries, including oil and gas. The Fed should be accountable to that and should answer members' questions about whether or not their distribution of the assets they purchased in the SMCCF is correct or not. I think the biggest issue right now is the systemic risk that climate poses to the financial system. There are very basic and easy supervisory actions that they can take outside the rulemaking process to force companies and banks to disclose their exposures to climate. Notably, insurance companies and asset managers like BlackRock are trying to get this information, and they have a very difficult time doing that. That's the perfect spot for regulators to interject at.
And the stabilization of credit conditions during COVID, it's been said, had more to do with the announcement of the lending facilities rather than the lending facilities themselves. But as been noted, these lending facilities, particularly the Main Street and the Municipal Liquidity Facility, have been shown to be ineffective. Do you think that that undermines their ability to be a psychological backstop in the future, and does that strengthen the case for reforming them? Mr. Wooden?
Just to clarify, did you say they've been shown to be ineffective or effective?
But the municipal, ineffective. The Municipal Liquidity Facility had only 2 borrowers. And as I understand, the Main Street lending program, even though it had $600 billion of capacity, it only lent $16 billion. So that's hardly a success story in my mind.
So I believe it is a success story, not because of the amount of capital, which represented about 2.3% programmatically, but because of what it did for the market and the access it provided and that stability at a time of extreme volatility. So I think that is one extremely important metric of success. As we've touched upon, actual delivering capital and support to municipalities across this country, in that metric, it was not as successful. But the first metric.
No, I will concede the point about psychology, but how do we restructure these programs to be more effective?
Well, in the recommendations and there in my written submitted testimony as well, I think standing up a program now, because speed is key, but what happens, and we've seen this with virtually every fiscal stimulus support program, it goes so fast and there's so much that's missed. And that's why I'm recommending standing up a program, not for permanent ongoing usage, but in advance. So we look at issues of size of municipalities. In the state of Connecticut, there wasn't one municipality that could benefit from it as initially structured. Two, when it was revised, but standing these up in the times of fiscal distress will allow us to execute more quickly and address some of these deficiencies that we're highlighting today.
Mr. Consul, according to Moody's, corporations are 63 times more likely to default on loans than states and municipalities, and yet states and municipalities, as well as small businesses, were subject to a much steeper penalty rate. I have the impression that the Fed is much more favorable to corporations and Wall Street than to Main Street and states and localities. Is that a fair analysis, or what's your impression?
That's absolutely true, that as empirical matter in the financial research, that municipalities default much less than their equivalent credit ratings from the ratings agencies, which put them at a huge disadvantage for accessing capital for our schools and for our roads and everything else. I think the Fed was very selective and mercurial even on how it picked its discount rate it applied and where it applied it. And in the future, it should be held much more accountable and much more standardized about how it does that.
My time has expired.
Thank you. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank all of you for being here today. The Federal Reserve took extraordinary measures during the pandemic because there was so much economic uncertainty surrounding the virus. Now, looking back, it seems like we may have misjudged the level of government involvement that was necessary to keep businesses aloft with some of these lending facilities. The private sector was willing and able to help businesses, and many of the Federal Reserve actions were not utilized to the extent that we assumed they would be needed. So if we misjudged the need for these facilities when we were in the heart of the pandemic, then we should not continue the practice of having the Federal Reserve competing, as we've talked today, with the private sector when they are able to provide proper liquidity for businesses. So, Mr. Russo, can you talk and you've done a little of this today, about some of the unintended consequences if we try to make these emergency measures permanent and constantly have the government competing with the private sector, which I believe is the power of America? Small businessman.
Thank you, sir, for that question. I think it's a very important one. Let's take a step back and talk about the economics. What are we doing when we set up an emergency lending facility to provide credit, not liquidity? We're setting a price. We're setting a price for credit of states, municipalities, corporations, business on Main Street. Can the government set prices as well as a market? In my view, as an economist, no, they cannot. I believe that is supported by over 100 years of academic research on this issue. We get outcomes that are not the outcomes we could achieve via a market, because a market is able to bring together all the sort of information that a central planning board cannot have.
Okay, thank you. I'm greatly concerned that some Democrats in Congress are looking to the Federal Reserve and other regulators to enact their radical agendas when they fail to get them passed in Congress. As some of you may be aware, I am in the car business. I'm a car dealer for 52 years and was targeted under Operation Choke Point when some of our agencies took a more proactive approach to achieve their policy goals. For those of you that may not remember, the Obama administration decided which legal industries posed a risk of money laundering and therefore must be debanked and denied financial services. I was involved in that. Bureaucrats behind closed doors were targeting legal American businesses, and there was no recourse if you were being targeted by our own government. I'm concerned the Federal Reserve will get back into the business of picking winners and picking losers. And if we set up permanent lending facilities with specific policy objectives. So again, Mr. Russo, can you talk about some of the risks that could happen when the Federal Reserve set up facilities with specific policy goals outside of their dual mandate?
Yes, sir. And I share your concerns in what you've articulated very much. In general, when the Fed has less independence to set interest rates and to do its large-scale asset purchases, it politicizes that process. But these are not political questions. The appropriate Fed funds rate, for example. But by involving Congress, you will make the Fed less effective, not only in its everyday interactions or its everyday actions, like choosing how much to buy on Wall Street, but even more than that, in a time of crisis. Involving reducing the Fed's independence has been shown and has happened in the past to reduce its effectiveness in a crisis. Let me give you one important example. Back in the Great Depression, the RFC set up by Congress was like a lender of last resort. Congress, unfortunately, leaked the list of borrowers to the RFC, and that created great stigma for those borrowers, worsening the effect of the Fed's interventions for the next 100 years. There's now stigma around the Fed's discount window. So there are real risks here that are not easily understood when you involve Congress in the monetary policy decisions of the Federal Reserve.
So we've got a minute to go, Mr. Russo. I'm going to let you have that time. I wanted to give you the opportunity to talk about inflation and some questions that you would like to get answered from Chairman Powell, since he will be before our committee next week.
Thank you, sir. So let me just emphasize that I agree with the monetary policy actions taken by the Federal Reserve. They've gotten national income up to where it would have been in the absence of the pandemic. And in my view, and the view of my colleagues at the Mercatus Center at George Mason University, that is a good metric for how a successful monetary policy is going to be. One question I would ask Powell is where in his mind are thresholds for re-examining his views about inflation, which, as you and others have articulated, he views as transitory. We've seen inflation expectations rise. And again, I don't want to be an alarmist here. I believe that inflation is transitory. But in his view, if we got inflation expectations from, say, 3 to 4% or to 5%, where would he pause and re-examine? I think that'd be a very important question to ask him. Another question that I think he'd be reluctant to answer, but I think is important to ask anyway, is what his time frame is for thinking about average inflation targeting. Over the past 6 years, we've averaged 2% inflation, according to the Fed's preferred measure. With all the inflation we've had, again, we've gotten national income right back on track. How long of a window is he looking at?
Thank you, Mr. Chairman. I yield my time back.
Thank you. The gentleman from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you to all of our testifiers today. And I'm really delighted that the chairman chose to have this hearing to examine and measure what successes we had in this past year during an incredibly challenging time to health and to our economy, and to learn what we can learn for the future, to do it better in the future when other crises arrive. One thing I wanted to look at is a possible barrier that we believe took place last year. In July of last year, at our hearing on monetary policy and the state of the economy, I asked Chairman Powell about nationally recognized statistical rating organizations, NRSROs, and the Fed or Treasury's decision to accept only ratings from the big three for businesses applying for emergency lending facilities. We saw that the lending facilities were underused during the pandemic. Do you believe, I'll start maybe with Mr. Consul, do you believe that accepting only the three big rating agencies was a barrier to some businesses in their application for support?
I believe the fundamental barrier for uptake on a lot of these programs, for the physical loan uptake, was the fact that there was a downside from the point of view of a business of having a penalty rate, but no corresponding upside. So once the market stabilized, for many borrowers, they could turn to the market. And thus, really what the Fed was doing was setting the interest rate in the same way it sets the short-term interest rate. I don't know enough about the nature of the ratings agency business right now to answer that.
I wonder, Ms. Reed, would you care to comment on that? Would it have helped if small businesses who had acceptable credit rating with other nationally recognized rating agencies would have been able to apply?
I'm not specifically informed on the national rating agencies part of it, but one of the reasons why the Fed does have all the requirements and the barriers that goes in is really these facilities are really meant to be emergency. It's really meant to be short term. We talked a lot about how it acts as sometimes a kind of a restarter for the market, a backstop for the market. So in some sense, I think just focusing on the utilization itself is really not a fair judgment on whether a program was effective or not. There are various things that, various factors that you look at, and also look at what really the intention of these facilities were when it was first announced by the Fed and the Treasury. So really need to remember that when Fed is really enacting these 13.3 authority and really announcing these facilities, it's really in the hopes that returning the markets back to normal and then also exiting pretty quickly so that it's not affecting the market in long term.
I appreciate that, and this is, my questions are a way of putting in a shameless plug for legislation that I introduced last year along with Chairwoman Waters and Ranking Member Barr, which we did pass in a bipartisan way, that would have the Fed treat all national credit rating agencies uniformly. I hope we will be able to do that so that barriers to small businesses, women-owned businesses, minority-owned businesses will be reduced in any way that we can. If I could, I think I still have a moment. Treasurer Wooten, in your testimony, you recommended a number of reforms to the municipal liquidity facility, including establishing a permanent emergency program. Would you mind just fleshing that out a little more?
Sure. With these programs, we always in the first few weeks, months, discover in a moment of crisis how many deficiencies exist. And going through this experience, right, they say you should never let a good crisis go to waste. In this case, we have a lot of learning from that. And I think standing it up, because we do need the speed with which Congress moved last time, we just need a better product. And if we take the time now to incorporate the lessons, improve on those deficiencies, and still leave it as an emergency use authorization, that will create a better product, as well as, going back to the state of Connecticut's experience, we would have had to, and I drafted legislation to allow municipalities to access the federal program through the state of Connecticut. We had to stand that up, so we couldn't use it. But having an existing shelf-ready program will allow states and municipalities to put mechanisms in place in advance should that fiscal crisis emerge.
I thank you all for your thoughtful answers, and I yield back.
Thank you. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Thank you, Chairman. I appreciate Chair Himes and Ranking Member Barr for this hearing, the opportunity to visit with all of you about your suggestions on the recent crisis and the Fed and the Treasury's response to it. I've spent the last, since April last year, I've been on the Oversight Commission appointed by Mr. McCarthy to oversee the Fed and the Treasury's response. And it's just down to Pat Toomey and me because Leader Schumer and Leader Pelosi have not appointed any Democrats to that oversight responsibility. So I don't know how seriously they take overseeing the post-CARES Act funding. But let me say that a couple of points. One, I agree with Mr. Russo and Ms. Ray talking about this is an emergency facility. And the guardrails around that include all the things that Mr. Russo pointed out, including a penalty rate, short-term, abundant collateral, exigent circumstances, broad-based eligibility, so that the Fed isn't targeting and playing favorites, and it is short-term. So the ability to, quote, have a permanent emergency is truly the oxymoron that is. We can't do that. We won't do that. And I would remind my friends on the other side of the aisle that these classic ageless, timeless central bank rules about lending as the last resort in an emergency were codified by who? Democrats in the Dodd-Frank Act. And so I agree with that aspect of the Dodd-Frank Act. I think we should be very vigilant about not turning the Fed into, as Mr. Russo says, a credit allocating piggy bank. Now, to my friend from New York, saying that somehow these facilities benefited the oil and gas industry. Certainly not in the TALF, which was trying to help short-term credit for borrowers, student loans, housing, credit cards. Certainly not in the corporate program that brought a broad section of corporate bonds and corporate ETFs. Certainly not in the emergency facilities for airlines or for the defense industry. So that leaves either the Municipal Liquidity Facility, don't believe there were any energy companies in the two loans, or Main Street. Now, Main Street, I looked it up while we were sitting here, made 1,830 loans for $17.5 billion on Main Street. 8% was to anybody in an industry classification of oil and gas or mining, 8%. So I don't think that's overwhelming. I don't know what oil and gas and mining are as a percentage of the GDP, but I'll also tell you at the moment this crisis hit, oil and gas prices collapsed. Reserve valuations in the oil and gas industry collapsed last March. Please remember that. And people could not access the public markets. So I think the Fed and the Treasury, under the circumstances, did outstanding work. And I think this Congress responded to the emergency to benefit state and local governments. Mr. Russo, on this aspect of federal credit allocation, did that work well with Synfuels with Jimmy Carter?
I'm sorry, I missed the very end of your question. Did it work well?
With Synfuels loan with Jimmy Carter. You weren't born, but did it work well? Your answer is no, thank you.
That's why I didn't understand the reference.
How about Solyndra in the recovery plan after '09? Was Solyndra a good allocation of credit?
I don't have an opinion, but I don't believe the Wall Street Journal thought so.
Yeah, okay. So let me say that when we get into the direct credit allocation business, we get into trouble and we compromise the Fed's credibility and independence. And I'll tell you, look at the national security loans in the CARES Act authorized by this Congress. We helped airlines. We were to help the defense industry. I would ask you to read the Oversight Commission reports on the defense industry. We loaned $750 billion to Yellow Freight because it was essential, according to DOD, to national security, when all the testimony before our commission says it was not essential to national security. Therefore, the largest loan there is really probably done not in accordance with the CARES Act statute, but it was made. It's an emergency. It's a crisis, but that's why credit allocation is so troubling. Mr. Chairman, I don't know what this legislation was that was attached to the bill. We haven't talked about it today. So I have concerns why that's been noticed for this hearing but never discussed. So with that, let me yield back my time and thank the committee and the witnesses.
Thank you. The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes.
Thank you, Chairman Himes and Ranking Member Barr, for holding this important discussion. And I want to thank our witnesses for joining us today. When I first saw that the Federal Reserve was establishing a facility to help municipal bonds, I was relieved because I know firsthand how challenging the municipal bond market can be. I served in the Chicago City Council, in the Illinois Senate, and the Cook County Board. Unfortunately, our bond ratings make national news. But what that means for us who live in working class communities like mine is that schools, clinics, and libraries closed. It means that my neighbors worry about pay cuts and layoffs every budget season. And you don't need an economist to see that makes our economy worse. So I had hoped that the Fed's Municipal Liquidity Facility would offer some relief, but I represent one of the very few communities that actually use the MLF, and there's a reason many jurisdictions didn't sign up for the program. My state, Illinois, had to attest that we couldn't get financing in the private market before getting help from the MLF. And once we got help, the rates were barely better than the private bond market. So I'd like to direct my first question to Mr. Wooden. When the Fed helped out the corporate bond market last year, did they have to deal with similar terms, the same level of stigma?
With respect to, I did not follow the corporate bond market as I did with the municipal markets. But from my general knowledge, I think the answer is, of course not. There is always a different standard with respect to the corporate markets than the municipal markets.
Okay. And do you think that the municipal lending facility was designed fairly, or did it stigmatize municipal borrowers?
So I will give you in the midst of the height of the pandemic response, which is, I thought it was unfair to state and local governments at the time, the penalty, the off-market rates, and the burdens associated with accessing it. And certainly the fact that it was designed so that not one municipality in the state of Connecticut was eligible for it. With that said, given how our finances turned out in the state of Connecticut and our ability to access the traditional markets and how the facility stabilized the markets more broadly, there was certainly a benefit to the state of Connecticut and to most states in the country as a result on that metric, but not in our ability to actually help municipalities in the midst of the pandemic.
Thank you. Ms. Sam, we're now going through a major crisis, but of course that doesn't seem to be anything new. Every few years, municipal budgets get squeezed because of problems in Washington or Wall Street. After the last financial crisis, municipal defaults and bond rating cuts hurt cities across the country and cut our recovery short. The MLF was a good idea, but it was too little and too limited. How can we proactively address municipal bond issues in the future so that my neighbors don't worry about budget cuts and layoffs because of problems they didn't create?
Right. I think one step forward would be to create more certainty. So to take this time to really structure those programs, make sure municipalities know how to access them, to the point, make sure more municipalities can access them if they need to. I think we've heard a number of times this question of whether emergency lending facilities are permanent or not. That power is in the Federal Reserve Act. Now it has to be authorized by Treasury, but emergency lending facilities will be used in future crises. So, and I very much hope they will be used for state and local governments. And that means that we should do everything we can to make sure they work for state and local governments. And I agree, there's a long way to go here.
Thank you very much, Mr. Chair. I yield back.
Thank you. The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
I thank the chairman, and I thank our witnesses for participating in this hearing and our colleagues, but I really want to take a little bit of time to explain what happened, not a theory, but what happened, because there's really a range of things that I think have been misstated as part of today's hearing. Perhaps just people don't understand. I note that there aren't any actual market participants in here. Municipal bonds, so the treasurer, thank you for coming, huge part of the market and a big part of what we're talking about today. But during the last half of March and really a lot of April of 2020, the Federal Reserve acted boldly and decisively in an unprecedented way. I think PhDs will be written for decades about what went right and wrong there. But for the action of the Federal Reserve and 13.3 provisions, which were frankly stretched to the max of their statutory limit, we would have really had a massive collapse in our markets. Markets work when there's equilibrium between buyers and sellers, and there was no buy side. I spoke to a hedge fund manager that had $800 million in cash on his balance sheet at the time in a pretty conservatively managed fund. And in a period of 10 days, they burnt through over $500 million in margin calls. So what are margin calls? Everyone in the room understands, but not everyone listening or watching does. So if a company has 50% leverage, i.e. they've borrowed 50% and they put 50% equity in, and the value of, say, $10 million worth of bonds goes down to $4 million, well, now they've got a $3 million margin call. So call after call after call, the market was in free fall. It was true in municipal bonds. There was no buy side. So why did the municipal liquidity facility work? Well, it wasn't because of the two loans they made, Mr. Torres. It was because of the hundreds of billions of dollars of loans that were facilitated because the market now knew there would be a buy side. So the free fall stopped, the margin call death spiral stopped. It literally bankrupted hedge funds, and no one's really sympathetic to hedge funds, but what happens when that fails? Well, the pension dollars that are in those funds go away. So your teachers, firefighters, policemen, and whatnot are out money. The hardworking men and women of America who are counting on us to make this work are hurt. And without decisive action, without these facilities, our market would not have worked. Now, there are some people who don't actually want us to have a market economy. And when they say they want to fundamentally remake America, that's code for they don't actually want market anymore. They want a centrally planned, centrally controlled financial system. And frankly, one of the features of our current monetary policy, where we're no longer constrained by the amount of tax revenue we collect or even constrained by the amount of money we can borrow, is that it threatens our financial system. It could actually collapse it. Now, it's hard to believe that people actually think that's a good thing, and very few will admit it publicly, but this is something that people that support modern monetary theory believe. Now, they believe it, maybe some do, that it can continue to work because we have a currency. And this is where things have shifted. We went from good, decisive action by the Fed in March and April to monetizing debt. The Fed's balance sheet's grown to $8 trillion. They've continued to inject $120 billion a month in a predictable way. And so they've got two roles. They're supposed to protect stable prices, i.e. the dollar as a store of value, and they're supposed to promote full employment. They're not doing well on either metric. And their last role is as a regulator. As a regulator, they've been schizophrenic. They've been encouraging all this liquidity in the marketplace. Lots of the cash has flowed to banks, but then they're discouraging banks from making loans. So because of that, they have acted as a lender of last resort. And I think, Mr. Hill and others, and Treasurer Wooden, I think you highlighted some of the challenges that could be done, managed if there was a predictable way 13.3 worked. But of course, it has to be known as an emergency, not a structural way to operate. So I wish there was a market participant in the room. I wish we could go into depth on all the reasons why modern monetary theory is a fallacy and why Congress, this body, actually has to be responsible in setting parameters and providing oversight. But I wanted to use my time differently than expected just to correct the record. So I yield.
Thank you. The gentleman from Massachusetts, Mr. Auchincloss, who is also the vice chair of the full committee, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Russo, in your written testimony, you indicate your concern with monetary policy becoming credit policy and the threat to political insulation that comes from that. I think those are reasonable concerns. You also refer to 6 programs that were stood up under the emergency lending facility that were designed to provide liquidity to the shadow banking system, which is not eligible for lending through the Fed's traditional lender of last resort tools. Can you explain more what the shadow banking system was in this circumstance?
Yes, thank you for that question, sir. The shadow banking system is effectively financial institutions on Wall Street that act like banks, but that don't fall under the Fed's usual regulatory apparatus. So they don't have access to the discount window, which is the Fed's usual tool. These 6 programs I highlighted, these were things that we were going to try to solve with Dodd-Frank, but in my opinion as an expert was unsuccessful. So for example, lending to the primary dealers to make sure they have the liquidity to keep markets moving, something that we would hope have been solved by Dodd-Frank. I think that was incomplete. So I'm uncomfortable with these programs, but in a crisis, given that it's an emergency, I understand that this is sort of an extension of lender of last resort to the shadow banking system.
So would you recommend that we incorporate the shadow banking system into the rules that allow the Fed to be a lender of last resort, or that we regulate the shadow banking system so that they're no longer banking? I mean, which one should we remove, the shadow or the banking from the shadow banking system?
So I think that's an excellent question. I'm a bit off my skis here. Let me refer to a colleague of mine who wrote a paper for the Mercatus Center on this topic and about COVID-19. One of his recommendations was moving the shadow banking system under the umbrella of Fed regulation. Another thing that he'd mentioned specifically, for example, the swap lines that the Fed created to swap dollars with foreign currencies at other central banks. He instead suggested that Congress end those, and that foreign banks, if they have liquidity problems in dollars, they use their local branches in New York to borrow from the discount window as intended.
Understood. You also referenced 10 programs that were intended to assist Congress and the Treasury in allocating credit beyond the traditional lender of last resort doctrine. And I know, of course, that you're very concerned about these, that these are really moving into credit policy away from monetary policy. Basic question here. Why is it that Treasury couldn't itself give loans? Why did the Fed have to backstop those loans?
So if I understood the rationale correctly, when you were passing the CARES Act, you desired for the Fed to sort of act as a leverage, a source of leverage. So the Treasury committed X amount, and the Fed tries to leverage that up by printing money, essentially. And so that was one of the views that was given. I think another, and again, here I'm really speculating on your own intentions, but it might be because the Fed, as a central bank, has people who are very smart and able to work in these incredibly difficult situations and have connections to market participants. My hope is that I don't want to judge what was done in the past, but looking ahead, let's get the system right so we don't have to do it through the Fed again.
So Dr. Samad said in the last back and forth that these emergency lending facilities are here to stay with the Fed, that they are statutory, and that we should expect to use them again. I saw that you were shaking your head as she was saying that. Are you disagreeing that they are permanent, or are you disagreeing that they should be used again, or?
Sir, thank you. I hope they're not permanent, and I'm not a lawyer here. I can only read the plain language of the law. And so when the Dodd-Frank Act amended 13.3 to say that the 13.3 lending must be broad-based in unusual and exigent circumstances, unusual and exigent doesn't mean every day. And so again, for the Fed's independence, I would strongly urge Congress not to make these a permanent part of the Fed's arsenal.
Would you, and Dr. Sam, please jump in here, would you recommend that Congress provide more detail about what unusual and exigent is?
Right, and to be clear, I wasn't saying that I think these should be standing facilities.
Right.
I was just pointing out 13.3 is in the Federal Reserve Act. It is absolutely the authority of Congress to amend that. I think in general, more broad than your question, Congress should really lean into its role of defining what it wants the Fed to do. The Fed is going to follow orders. It is good at that, but guidance from Congress will help it achieve what you all want it to achieve. So what are exigent circumstances, that can be defined. That language has been in there a long time. So
Ms. Rhee, in the last 30 seconds here, do you want to take a crack, given that your expertise is in systemic risk, if you had to define unusual and exigent circumstances in 20 seconds, how would you do it?
I don't know if anyone can actually, define that. That's kind of prescribing what's going to happen, in a financial crisis, trying to decide what the predicators are for a financial crisis. I think that has been unsuccessful. So I think it's really, you need to depend on the experience of the policymakers. You also have to look upon beyond the US example and see what kind of creates a financial crisis and what indicates that we're in a systemic risk. I think one of the challenges...
Ms. Rhee, may I have more questions? Are you familiar at all with any of the work that the Santa Fe Institute has done on predicting systemic risk? And
I've heard about that, yep.
Do you think that that could be a tool used by policymakers to understand where risk is getting so correlated that it's becoming systemic and might be unusual and exigent?
I think there may be various factors, indicators that you can use. IMF has some indicators also. But be it all that, it's going to be hard to prescribe exactly what it means because the financial market is changing. There are different factors and products that are going to come out. So,
Understood. Mr. Chair, thank you for the leniency. I yield back.
Thank you. Since there are no more members asking questions, we will conclude this hearing now. I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days with which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days with which to submit extraneous materials to the chair for inclusion in the record. I remind members that written questions and materials for the record should be submitted to email addresses provided to your offices. The hearing is now adjourned.